So welcome. Thank you all for joining. I'm Robin Proctor. I'm the Medical Director for Professional Practice in the college. This is our 5th webinar now for clinical directors and is part of the network for clinical leads, clinical directors, whatever we're called in your place, as one of the means that we can get together a network and try and support each other. I think it's one of the toughest jobs in the NHS. So congratulations for sticking it out, and hopefully we can offer some peer support while we're going through that. There's going to be a short survey at the end that we'll put into chat, so please take a minute to fill that in, give us your thoughts, and hopefully we can refine what we're doing and make them continue to be valuable. Webinars are one element. Hopefully you're members of the WhatsApp group chat that's quite lively, and also receiving a monthly email update that we've restructured a bit to hopefully give half for you and half for the rest of the department. To feel free to forward that mail on to your colleagues. I've got a couple of announcements just before we get into the main session about RCR items to bring to your attention. The first is a big thank you around the RCR census that for quite a few years we've had 100% return rate of exactly what's going on in radiology departments around all 4 nations. And that's incredibly impactful. It gets quoted in Parliament, it gets used by policymakers, and it's because we've got 100% return that it's so authoritative. So if you haven't had a chance to fill it in, it's been bumped down the list, or you know a CD somewhere who hasn't filled it in, then please try and get to it. If you need a reduced question set, you're struggling with it, or there's some problem, please let me know if there's any kind of issue. The other things to highlight, within the Clinical Directors Network, we're looking for a few volunteers of people to bounce ideas off and be involved in sort of leading the decision making and thought production of what should come up next. So if you're interested in that, please get involved. I think Amy can drop a link into the address. It's Professional Networks, all one word, at rcr.ac.uk. Professional Networks at rcr.ac.uk. The RCR is going to be hosting a jobs board if you want somewhere to advertise and look for suitable candidates. That will be going live early in December, so keep an eye out for that. And just to plug some of the RCR guidance that's recently been published, you may have seen things coming out on artificial intelligence, deployment fundamentals, around an update of the sedation and analgesia anesthesia document in radiology. And the paediatric element of major trauma has come out after the adult element came out earlier in the year. So that really brings me on to the main part of the day, and we're wanting to get something that's useful for clinical directors. And what's come up repeatedly is how to grow a service. So we've got 3 strands of what we're going to look at tonight. First bit is to look at financial literacy, and certainly what I wish I'd known when I first became a clinical lead about how what some of the accountancy terms mean and what the dark magic of accounts is actually about. We'll then look at how to demonstrate the value of a radiologist from the clinical leads perspective, and then from a different trust from the finance professionals perspective. So I'm going to stop my parish notices there and invite David Botha, who's the Director of Finance and Business Resources within the college, to take over the screen and give us his insights into basic financial literacy. Thanks, David.
Thank you very much, Robin. Thank you for that welcome. I have a set of slides which I will try and present. Here it is. Yes, fantastic. When I was preparing for this, I was looking at various material that was on NHS One and various other websites, and they all seem to be dozens, if not hundreds of pages long in terms of guidance. So I've tried to condense this down to only 7 pages or so. So my start point is to try and help you understand what makes finance people tick. What is important to the finance people, the language that they use so that we can get rid of or understand the jargon that's there. Interpretation of some of the basic financial management reports, and I've got an example that's been given to me, and finally some, I suppose, advice from me as to how to approach whatever the challenge is. If it's growing your service, how to actually approach that in your particular trust. So a little bit about finance people. Finance people are focused on monitoring the big financial picture. And there's really three components to this kind of work that we do. Ensuring that we have the right accounting that's taking place in a department is important, in a organization is important, because there are standards that need to be observed. We need to make sure that there's comparability and consistency across different organizations so that you can make comparisons, and that there's a pretty consistent sort of top-down view. Finance is also about effective control. Basic level, this is about building a good budget and then managing the various small controls that fit around that, ensuring that invoices are properly approved, expenses are properly approved, that then when budgets are monitored and reported against, that people understand the variances that are there and we're able to escalate that. Finance, a large part of finance is also about compliance with a set of rules, and in this case they're largely going to be the broader NHS and public sector framework that you need to operate within, and these ensure that well, the NHS for yourselves, RCR for us, are just demonstrating good value for money, us for members, yourselves for taxpayers. Okay. So a little bit about finance jargon. So I've got three slides here on this. Some of the finance jargon is fairly obvious, I think, but this is things like income, spend, cash, actuals, and maybe the word budget. But some of it is completely made up by finance people, and it's a lot more difficult to understand. So I'll try and illustrate with an example. The items are on the right-hand side of the screen. Okay. So supposing we had a 12-month contract for a mobile phone. The contract starts in January, finishes in December, and you don't get a bill for this mobile phone until February sometime because the invoice is late. What will happen with that contract is finance, in your budget, hopefully you will have 12 months worth of a mobile phone cost. Finance should come to you in January and say, where's the mobile phone cost? You say, we haven't got the invoice. So finance then make an estimate of what that cost is. That's an accrual. It's just a fancy word for an estimate from finance as to what the cost should be in any particular month. And it's just a way of making sure we're recording commitments that are made that will be seen later on in the year. When that mobile phone bill is then paid, we'll be paying the full 12 months of it at one time. That's called a prepayment, paying it before the cost is incurred, before the contract is fully used. So this prepayment is then spread out over the next 12 months, over the remaining time of the contract. It won't necessarily be 12 months. And that is what prepayments are. Another term you might hear is depreciation. Sometimes people use amortization. Again, these are really exactly the same things, but they're taking capital spend and spreading it out over years rather than simply months to reflect the fact that a capital project is supposed to give benefits over a longer period of time. I'm going to give an example of some management accounts, and I hope that these are current, as in actually they might be familiar to people on the screen. So management accounts, the key things about them is they need to make sure that they're a comprehensive view of all the resources that you actually control, not shared with other parties. So you need to ask your finance team to make sure that that's the case. They need to also be meaningful to you in terms of the descriptions given against the various costs and codes and things here. And you need to have access to the budgets that underpin them and the budget assumptions that underpin these. Couple of features about the numbers. In pretty much all the management accounts you're likely to see, you'll be asked about what's happening in the month, and you'll have the in-month information. And you'll also be given the year-to-date position. Both of those two things are important for different reasons, but essentially it's all about understanding the variances and what's actually going on. The helpfully in this set of management accounts, the adverse variances are shown in as positives. So that top line there, they've spent more money than they actually have budget for. So there's an adverse variance of £6,500, and that's shown as a positive feature, positive value. You might find in sets of management accounts that that's not the case. It's shown a different way, but you'll need to look at that and just make sure you're interpreting them properly. Okay. One thing that I've identified is that some of the budgets can be very complex to navigate. And I wanted to highlight a couple of things here. Firstly, budgets are split really into two sections. There's revenue budgets and there's capital budgets. Revenue budgets are for all the day-to-day activities, the departmental activities, salaries, consumables, spend, and what have you. Capital budgets are about equipment, or about buildings, or about modifying things, or sometimes even software as well. And they are two separate budgets. They're not interchangeable. So if you underspend in a revenue budget, it doesn't give you any freedom in your capital budget, and vice versa. Okay. The other thing to note about budgets is that, and this is particularly important if you're trying to build in something new, is that you've got to find the right budget to actually work with. So the on the screen here, the light blue circle at the bottom is about the annual budget. But at a trust level, there should be a strategic plan which covers maybe 3 to 5 years. And the budget that you're seeing at a trust in your departmental level is just going to be a subset of that, just a 1-year subset. So if you want to try and influence your departmental budget to change that service, to expand it in some way, you need to make sure it's built into the trust level strategic plan. And I've got some guidance on how we might be able to do that in a second. Okay, so final bit from me. In order to be able to have this kind of influence and affect these kind of changes from a financial point of view, is my advice. Make sure you're doing the basics properly. So this is engaging with the management accounts, understanding the budget, what are the variances. You have to like the budget, but you do need to understand it and understand the assumptions in it. And hopefully the jargon that I've provided, or jargon buster I've provided, can help you a little bit with that. Do observe good governance. And this is, there will be a set of rules, standing financial instructions for your trust, various other value for money guides, and other more granular rules. Do observe those things. I said mavericks are seldom indulged. This is the NHS, not politics. So if you stick to the rules, it helps finance better appreciate what you can provide or look to try and do. Do look to try and influence the right level of budget. So this is about which is the big picture do you want to influence? Is it the trust budget? Is it the trust strategic plan? And changes to services generally going to involve the trust strategic plan, making sure that there's sufficient resources and things in there. Okay. And final point for me, just ask for support in building your case for this. You should have access to finance business partners who should be able to help you navigate this process, act as a critical friend, and generally give guidance around helping you to deliver what it is that you want to deliver, or the change you want to deliver. That's it from me. I think I'm not quite 10 minutes, but I shall leave the screen now. Thank you.
Thank you very much, David. If anyone has any burning questions for David, please either stick your hand up or put them in chat. We can pick them up now. I know you're going to stay with us, and we're hoping to have a chance to have a conversation once we've heard from all three speakers. I can't see any hands, so I'll just need to get back to chat. Thank you very much indeed. I'd like to invite next Dr Amrish Mehta, who's the clinical lead in Imperial College in London, to give to give a view from the clinical leader's perspective. You've been successful, Amrish, in demonstrating the value of getting funding. So I'm sure there's a lot of people wanting to emulate what you've done. The floor is yours.
Thanks, Robin. So nice to see you. It's nice to recognise a few names as well that I've worked with in the past. So thanks very much for inviting me. So this is quite a sort of a challenging topic, and I think the environment is set to get worse, I think, in terms of making the financial arguments for more radiologists and recruitment. And I just want to give you our experience. It's based on a few things that you will have seen me present in different RCR webinars. But I think the first step, if I can give you my sort of thoughts over the last few years. So I was clinical director from 2017 to 2022, and I'm now one of the divisional directors. And obviously I see these things come through from my successor in the division, and it still works. And we've had a very, very successful track record of recruiting using this same sort of technique over the last 5 or 6 years. And we've recruited 28 consultants in the last 5 years, which is quite a phenomenal achievement. And we were really short on the ground prior to that. So I'm trying to try and set this out logically, and I don't really want to use slides, but I'm going to have to at some point. But the first thing I think is to set out your plans in a sort of in a paper. There's no getting away from putting stuff down on paper, ideally ahead of any business case for recruitment. And what that does is it sets out your strategic overview of what the problem is. And I did that once, and we've not had to do that again. So we set all of our business cases against that strategic paper. We probably need to refresh it every few years, and I think Elika, who's the current CD, is looking to do that now because it's been about 6 years. But actually, it's really helpful for executives to see what is the overarching problem, and then any subsequent papers can refer to that overarching problem, and you don't have to go through all of the background over and over and over again. What you have to do then is just refresh some of the data in that business case. So that's my first suggestion, and I've got some slides here that actually are taken exactly from that process when I first did it. Okay, so and this is the first document I put through when I was taking this to the executive, and it essentially sets out what we needed to do. So the first thing is you want to set out the overall challenge, and that really is around what the growth and demand is. And this slide doesn't include that because you all know all of this information. So it's what's the overall problem? So it's growth and demand. You do need to make an assessment, or at least you need to convince your executives and your leaders that you aren't just ignoring the growth and demand. There's a real concern that we're not watching demand and that we're not optimizing demand, that we're just letting it do what it does. Now, we all know that demand is extremely difficult to manage, and some people now want to use the word optimize. It's really difficult. But I do think you need to be clear that you are looking at it where possible. So, for example, you are trying to implement CDS, so clinical decision support, so that you're trying to manage that if that's going on in your organization or your network, that you are managing, that you are looking at audits for head injury CT, you are making sure that your silver traumas aren't being unnecessarily scanned from top to bottom, all of which is difficult, and that you are looking at your sort of high volume referrers to make sure that they are appropriate. And a good example is MS in my world. You know, we've got to make sure that we're not just scanning umpteen dozen of brains and MRIs every 5 minutes just because there's a new treatment out there. And it's a difficult one, but you do need to allude to the fact you are looking at demand. But then you need very specific information about your own department and your own organization. And that consists of a number of elements. So the first is you need to be able to evaluate your own team's capacity. So what can they report? And for that, you need some form of output metric. You cannot hide from an output metric. And I don't want to go into that too much because we've shared our points-based output metric, and the RCR has shared that as well in their documentation last year, I think. But I would recommend using a points-based system. It's much more nuanced in my view, and it captures complexity in a way that's not done with the simple 1, 2, 3, 4 part process that is also possible. But to be honest, either way is helpful. And what the output metric allows you to do then is be able to evidence that your team is performing appropriately for the salaries that you're paying them. And it's basically a value for money argument that you need to make first, that gives you assurance as the clinical director or clinical lead that your team are maximally producing what you said they could produce. And it underlines your capacity argument, but secondly, enables you to justify any additional expenditure that you may need to incur. But then the crucial other part of it is that, and that's the sort of how we arranged our output metric. I've shown these slides before. You'll have seen the output metric that we've shared with the college. But then you need to figure out what your reporting capacity is. And this is what we did in our most recent, actually, I think it was the one before our most recent business case. And you need to be able to then do detailed job planning to accurately assess the amount of hours in your team's job plans that are for producing reports or for doing procedures or ultrasound scans or whatever it is that they're doing. And our output metric allows you to capture all of that. But the job planning needs to be really quite granular and meaningful. You need to be able to have proper discussions with your individual colleagues to nail down, to both their satisfaction, but also in terms of the needs of the department, exactly what it is that they are able to do in their job plan. But once you've determined the number of hours that they're available for producing reports or doing procedures, you can then use the points-based system to evaluate the capacity of your team. And that you can slice and dice by any specialty. So for example, up here, I've been able to say what our imaging team a year ago was able to deliver. And you can see that the neuroradiology team were doing that many hours, that number of points, and so forth, so on and so forth, and all other teams on the right. And you can see what the total MRI and CT reporting capacity is. And using that, if you've got detailed job planning, you can then apply the points-based metric to any portion of that job plan. So you can do it for just PET-CT, you can do it for the nuclear medicine team, you can do it for IR, you can do it for plain film if you wish. And you can determine what the capacity is. And that then allows you to make some, we can skip that, that's not terribly helpful. But then what you've got to do is determine your demand. And the demand we use, different ways of doing this, but I would suggest the simplest is to just look at your last year's activity. And you map last year's activity. So this was the activity in terms of number of investigations of various complexities. So again, you're using the output metric table. So you can see the whole numbers of exams, and they are converted using the points-based system automatically using lookup table to the number of points. And then you can simplify that into various pods and groups. And you can see that here, that the total number of CT and MRI activity in that year was 1.3 million points. Remember, this is just a currency, but it's a standardized currency that you can stand behind and explain to anybody that wants to know. And I think that's the crucial point. The reason why I say we use this, of course, this assumes that everything that was done last year was demand. It doesn't necessarily include stuff that wasn't reported. So, you know, sitting in a backlog, for example. So if you have a substantial backlog, you could add the stuff that's in your backlog, averaged out, apply that to the points-based metric, and you could add that to your total number of points. Either way, you come out with a total number of points. And then the other thing that I don't want to talk about too much, let me just stop sharing for a second, is the demand modeling tool. So you might recall that, again, on a previous webinar, I've talked colleagues through the demand capacity modeling tool. So you enter those numbers. So you've now got your baseline demand, you've got your capacity number that goes in here, you can apply different growth rates, and ultimately what it allows you to do is enter the right number of consultants automatically. I've shown you this before, so I don't really want to spend too much time on it, but you can enter the number of consultants you need in here that takes your lines of capacity up to your demand line. And that tells you how many consultants you need. But the really important thing then is to make the financial analysis. And it's quite helpful that I'm just following on from the previous speaker, because what you really want to do then is to be able to say, just give me a sec, I'm just going to minimize that, is what your cost per point analysis is. And this, I think, is really important. So once you've determined the capacity, you've determined the demand, you now know how many consultants you need, you've got to then be able to make the argument that it's cost effective to recruit those consultants. Because the challenge that we hear up and down the country is that actually, if you need more reporting capacity, why don't we just outsource it? Or less severe than that, why don't your existing team just do a whole load of insourcing or waiting list initiatives? But I just wanted to bring this calculation to you. So you can see here that what you've got is a number of consultants. So you've got a standard sort of consultant type job plan. You've got total number of PAs, and I'll explain the 3 options in a minute. All of our posts are 8 plus 2, so 8 DCCs and 2 SPAs. So that's the same for all 3 of these. And I'm assuming these are all full-time consultants. I'm going to park this line for a second. This is non-output DCCs and come back to it in a second. That leaves, depending on which of these options you take, the number of output DCCs from the job plan in a new consultant as this. Then you've got the total number of output hours, total number of annual output hours, and that converts into the number of points. And using a salary, so when I first started doing this, the total on cost for a salary in a consultant NHS post was about 130,000. It's now, I think most financial teams will be using a base point of 145K for a new consultant. So at a cost per point for a salaried consultant, if you take option A, which is 8 DCCs, 1 non-output DCC, so 7 reporting DCCs, comes out at £5.14 per point. We have a insourcing cost model again in Northwest London across all 4 of our organisations of £5 per point. And we've just recently gone through a tendering process. It was actually about 5-6 months ago now. And if you make a like-for-like comparison, because of course they use a part system, 1, 2, 3, 4 part system. But if you make a like-for-like comparison between our points-based metric and their parts-based metric, it turns out that it costs about £6.17, including VAT, for outsourcing. So you can see here that it's basically cheaper to recruit a consultant than it is to outsource in Northwest London. And it's about the same cost to insource as it is to recruit, particularly if you're only giving 1 PA to non-output DCCs. But before I go into that a bit further, I wanted to highlight that that doesn't take into account all of the additional benefit you get from a substantive consultant. This is just a cost per point analysis for reporting or output if it's procedures. So you don't include the fact that you might have more resilience for reporting itself, you might have more resilience for on-call, you certainly have more resilience for MDTs, you're going to have a contribution to governance, teaching, research, management, which includes improvement work, quality improvement work, and leadership. And I think those are really important. And the only other thing I wanted to say that you can see then that there is a bit of a tipping point. It turns out that if you are closer to 15% of the job plan being non-output time, it stands to reason, therefore, it's going to be more expensive per point. And so we have a limit at Imperial and largely across, but not entirely across Northwest London, that no job plan, where possible, should allow more than 1.5 PAs of non-output time. So you've got to be quite tight with the distribution of vetting time and clinical admin time, and in particular MDT time. And I think those are the key points I really wanted to raise, Robin. So it's have an output metric, use it to justify your salaries, use it to, let me just stop sharing for a second. And use it to justify your salaries, but then equally use it for the analysis of your capacity, then use some form of demand and capacity modeling tool. I'm bound to suggest that ours is a good one because it largely automates everything for you. And then I would suggest that you then do some form of cost analysis that proves that you need these additional consultants and that it's better value for money for the organization if you recruit substantively rather than in-source or outsource. That's all I want to say, Robin.
Brilliant. Thank you so much, Amrish. I know there will be lots of questions swirling through people's minds. I'm going to suggest that we hear from Yazmin Roberts, who's a finance professional based in Plymouth. And with thanks to Dr. Rob Hodnett as well, who's worked with Yazmin, I'd like to get two different perspectives, and then I'll invite questions and open up for discussion if that's okay. Claire, I know your hand was up for if you've got a specific question for Amrish, do you want to pop it in the chat and we can pick it up as we go through, if that's okay. Thank you once again, Amrish.
Robin, you happy for me to share?
Yeah, yes, crack on. Thanks.
Lovely, thank you very much. So thanks for having me, everyone. It's the first time I've done anything like this, to be honest. So yeah, any questions, more than happy to take at the end. So I'm the Care Group Finance Business Partner down in Plymouth. Some of you might be able to see the lovely sunny background behind me. It doesn't look like this all the time. I'm just going to talk to you specifically about a business case that was recently submitted and accepted for expanding our consultant workforce down here in Plymouth, but specifically the key financial challenges that we've experienced in the run-up to this case. And again, thanks to Dr. Rob Hodnett for supporting with this throughout. So we're just going to start by looking at the case and a bit of a background to UHP, really, just in case none of you are aware. So we put the case forward for 16 whole-time equivalent substantive consultant radiologists. That will be phased over a 2-year period. Now, that level of recruitment has been worked out so that we can exit any existing arrangements with regard to outsourced reporting. So this brings everything back in-house. This has been on the Trust agenda since post-COVID times, which has clearly been on the agenda for a while now. It's a huge priority for the Trust to reduce our outsourcing spend to zero. So I must stress that recruitment to this scale is not something that we regularly see at the Trust. So the fact that this ticks off such a large corporate objective was a huge bonus for us. Now, realistically, how do we afford to do this? So we've now looked at converting outsourcing spend to substantive recruitment. Previously, the aim was to bring all outsourcing to zero spend. Now, that's not possible. We heavily rely on outsourcing. There's only one option, which is to either recruit or continue using outsourcing down here in Plymouth. You can see on the screen that the forecast outsourced reporting spend for this year is roughly expected to be in the region of £1.6 million. I've got a slide next which will show you the increase that we've experienced since about 2015-16. So spoiler alert, this reporting bill has increased year on year for a number of reasons. Usually it's often as a result of short-term solutions and poor planning, but that's often because we don't have any money as a trust. Now, we won't be alone in that situation. One of the reasons I've listed, it's incredibly challenging down here in Plymouth to fill vacancies, especially over the last 5 years. We're just about up to establishment at the minute, hence the need for this paper. But we have looked at all options, including utilising international recruitment as well. Where we have been successful in recruitment, we then experience the challenge that I'm sure you all have about retention of staff. And then secondly, I've listed on here temporary arrangements. So we have introduced some various scanners around the site to support DMO1 standards, mainly to support peaks in demand, which we thought were going to be temporary. Again, we tried to use the flexibility of outsourced reporting to offset that. Temporary, in hindsight, is definitely the wrong word. Some of these scanners are still here 5 years later. The Trust's ambition was always to switch off outsourcing, like I say, but now there's an understanding that we just are not in a position to do that. So this slide, thanks to Rob for preparing this graph, what we're basically looking at is the green section is how much capacity we have if we do not recruit any further. And then the red bar you can see above this is where we think the demand will end up. Obviously, there are some assumptions behind that demand, but you can see this red line here is going to be the outsourcing spend if we do nothing. And that's quite a scary projection for the Trust, which let's be honest, is unaffordable. So, like I say, our trust is no different to any other. I'm sure that you will work in trusts that are operating in a financial deficit. So what does that mean, really? So there's no profit or surplus to reinvest back into our services. So every single opportunity must be self-funding, which makes it incredibly challenging to invest, to expand, whatever it is that you want to do. The answer is usually no. So I'm sure a few of you are familiar with a financial contract. I won't go into any complexities with that, but essentially finance always need to demonstrate that there is a financial benefit at the end of each consultant appointment. And we've just seen some really great examples of how you can calculate and prove that. It is incredibly challenging from my perspective to quantify the financial benefit of a radiologist. The reason I say financial benefit is because, as we've just heard, there are so many other benefits that consultant radiologists bring, but they often cannot be quantified to some sort of financial benefit. So we have to ignore them in this sense, although they can be listed as other benefits. An example of that, an activity you undertake that doesn't attract income, just SPA time, MDT time, we find really hard to quantify as well. But, there are benefits to the trust and our patients. So I also find it really difficult to understand job plans. I don't know if that's something that's felt across other trusts from your finance folk, but yeah, working with our clinical director is really helpful. You might think there's a lot of jargon in finance. I definitely think there's a lot of jargon in job planning. So when we come on to KPIs, we essentially use the number of reports completed in a PA, in a reporting PA, I should say. We do use RCR guidelines to indicate what we can reasonably expect from a consultant in terms of reports per PA. And then we use cost avoidance. So what could that consultant bring in terms of reporting? What would we save in terms of outsourced scanning? And that would be the benefit to us. Now, we need to have enough reports prepared to offset the total cost to the trust to make each consultant financially viable. We've just heard a little bit about that just now. Whilst I appreciate there are a number of other activities that are value adding within job plans, they're extremely difficult to allocate financial values against, so we stick with reporting. Something I need to say is more often than not, financial objectives are not aligned to operational objectives. So you might find you've got very differing opinions to your finance colleagues. And often that can lead to some incredibly difficult conversations about productivity, efficiency, and what finance need to get out of you in order to prepare something that might be able to be turned into something that's financially viable. I do find that sometimes as a result of that, it can be challenging to maintain those relationships, but often, let's be honest, it's just a result of lack of understanding from either party. That can be worked through, and you can see there are huge benefits to be had at the other end of that. I often like to go into, say, patients and scanners, they're not widgets, reporting consultants are not robots. It's really important to try and stress that from a finance perspective. I often think sometimes the minute finance turn up at the door to meet you, there's a softened perception that finance lack appreciation for the fact that patients can be complex and, work isn't as straightforward as, okay, we'll do X number of reports per PA. So I do appreciate that. But from a finance perspective, we do need to be able to enumerate, quantify potential benefits and opportunities. And yeah, we need a tangible output that we can monitor against. So I appreciate there's a lot of limitations with that and you'll all have differing opinions. That's just the stance that we have to take. Probably worth pointing out as well that when we recruit a consultant, not only do those financial benefits need to be equal to or exceed the cost to the trust of employing that consultant, there are also some other costs to consider. So I've just listed on the screen, we've got PACS costs, medical secretaries, and then we've also got the trust cost of the trust of PAYE, national insurance, things like that. So all of those need to be covered with potential benefits. And the finance table you can see at the bottom, this is just our proposed phasing of what we're trying to do with our 16 consultants. You can see the PACS and medical secretaries cost below. There are limitations I've tried to touch upon already presented in the report. So one thing that we haven't looked at in line with the report is we're looking to invest in reporting radiographers. Now, some of your trusts might already be way ahead of ours with regards to this. That's another added layer of complexity in terms of working out what your reporting capacity plan looks like. Now, I've said that the 16 whole-time equivalent consultant radiologists will bring our reporting bill to zero, but obviously if we're trying to also invest in reporting radiographers, either that might help in the future with regards to meeting additional demand, or there'll be other benefits to be had somewhere else. But at the minute, we've not quantified that or taken that into account for the paper. there will be additional demand for MDTs, other DCC activity. This might then reduce the number of PAs available for reporting. We see that at the minute with some of our existing consultants. The magic number that we've agreed on in our trust to have a consultant financially viable seems to be around the 5 PA mark for reporting. Now that's based on an average consultant cost to the trust of 135k, so slightly cheaper than up in London. And then whilst we may be successful in recruitment over the forthcoming months, hopefully, each consultant does have the ability to challenge their job plan and have input into their own job plan based on their specialist interests and whatever else it is that you want to change. Unfortunately, that does mean that should the number of reporting PAs drop below 5, that consultant recruitment falls into a deficit position and is no longer financially viable. By that point, it's usually too late for finance to have any input, and a decision does need to be made by the reporting manager. And we just have to monitor the benefits going forwards. I just thought I'd include this. I appreciate the financials are probably a little bit small here, but please feel free to zoom in if you need to. So I won't take credit for this. This has been prepared for by my lovely colleague, Dr. Rob Hodnett. It's based on following conversations we've had together over the last couple months, I'd probably say. Maybe it probably goes back a year now, Rob, actually, time does fly. It's based on financial values from primary and secondary cost avoidance using a job plan. So just as an example, this is for an MSK consultant recruitment, and this demonstrates what we would expect from them, from our trust, to form a financial benefit. This is based on a number of body parts, so not on a point system. So that's potentially something we could look at doing down in Plymouth. But for the meantime, like I say, it's based on the number of body parts we'd expect to save, and then we can use the appropriate financial value in terms of our outsourced reporter. I need to say this is not a performance management tool in any way. We do not use it as such. It's just a really good indicator in terms of what we can expect. And in terms of doing any post-project evaluations, we can then compare back to this to see if actually the investment was worthwhile overall. So how did this paper get authorization in the end? So essentially it needs to make sense overall from a performance perspective, financially viable, and support the direction of the department. The investment will be closely monitored, as I say. There is still a risk that future recruitment can be held should the reality differ to what's been presented in the paper. And essentially, every consultant that we recruit will need to show a return on investment within that financial year. So that can be quite challenging as well. The final point I'd probably like to make is building on those relationships between operations and finance. It doesn't only assist you in getting the best value for money within your department, but it can also support your finance team in gaining a more accurate understanding of how financial value can be maximised through consultant job plans and other activities. Like I say, to me, trying to understand job plans is very, very hard. So I need the clinical input, as I'm sure you sometimes rely on the financial input as well. So yeah, that's it from me. Thank you very much.
Yes, that's brilliant. Thank you very much indeed. Thanks for sharing your screen. We've got a few questions that I'll pick through. I think what's coming through very clearly from all the talks is to work jointly with clinical and finance colleagues so that you're both understanding each other's position and language and putting forward a cogent message. So I'm going to go in a slightly reverse order through these questions. Jamie in Leeds is asking, how would you add in the income for allocated funding? So defined educational roles, so essentially funded roles like appraisal role or educational supervisor, clinical supervisor.
The next station is Canada Water. Doors will open on the right-hand side.
Who's that question to, Robin?
I don't know if you want to, Amrish, do you want to take it or? Yeah,
so I mean, I'm happy to. So all our educational roles are SPA time. So they're not involved in the financial equation because we accept that there will be up to 2 SPAs in every job plan. And obviously it varies a bit between people depending on what their commitments are. And if they've got external funding, then that would go on top for that individual consultant. But I don't think so. My take on Yazmin, that was really good to see. Thank you. And it's very similar to what our finance team did with our business cases. I think they're actually quite similar in their approach in many ways, because if you take the sort of costing side of it out, you're quite right, we're using a different salary base. But actually, compared to outsourcing, if you you remember my table, 5 PAs would still be about cheaper than outsourcing. So for us, the outsourcing was always going to be more expensive. What we were trying to do was make it as close to possible as insourcing, because we know that the team are exhausted and we don't want to rely on an insourcing model either, at least not to a very great extent. But I hope that answers the educational question. They're included in the SPA rather than DCC.
Thank you very much. There's a slightly different question around the non-output sessions, and I think you covered some of it is just bonus value, like vetting, for instance. Am I right?
Yeah. So just to pick up, I saw that question as well. So non-output DCC is not SPA. Non-output DCC is DCC, but it's to do with direct clinical care. So MDTs for us, I mean, I don't think I'm alone in this. DCC, so MDTs are direct clinical care. They're just not producing output. And equally, vetting is direct clinical care. Clinical admin is direct clinical care. So no, I wouldn't call those SPAs. I'd say they're non-output DCC.
Okay, and within that non-output DCC, you've modelled clearly on only the reporting time for primary de novo reports.
Yeah. Are
you aware of any work of saying, well, look, if I cover an MDT, then my reporting activity is displaced, so I'm going to give it a PA's worth of activity as though I was reporting, and model it somehow?
Well, no, because we shouldn't need to, because we're basing our whole model on the amount of time that you are producing reports. So we're factoring out non-output time, be it SPA or non-output DCC. And so provided that non-output time isn't excessive, and for us it's 2 SPAs and 1.5 DCC. So we need to be, our average is that people need to be doing 6.5 PAs of reporting in a full-time contract to make sure that we are there or thereabouts with insourcing and remain significantly below the outsourcing cost.
Okay, thank you. Yaz, do you want to come in and say anything different from a Plymouth perspective, or does that chime with what you've done as well?
All chimes in. Yeah, I'd agree with everything you've just said, really. So yeah, no differences there.
Okay, we've got quite a few more questions, so I'm going to come to Steve Harden and Priya Suresh first, then to Manoj, and then we'll pick up some more from the chat.
Yeah, thank you. I mean, 3 really brilliant talks, especially for a person who has a MDET or a trainer hat on. So very nice. I just wanted to ask, will these reporting, when you say that so many reports need to be done, or you're counting the values, will it include if you have a trainee with you, and or you have to check trainee reports? Because we are trying to, it's a challenge, constant challenge. We have 75 expansion posts this year again, and we need, to find places.
Right. So no, thanks, Priya. So, I mean, I know you know the answer to this because I've talked to you guys through it, but I think this is for the benefit of everyone else. But so the output metric that we use in NWL and that the RCR shared is based on in-job training. And I think that's crucial. So that's separate to EPAs for educational supervisor and clinical supervisor. This is what we all do every day when you have trainees with you. So we know it's going to be slower when you have trainees involved in your program. And that varies because if you've got a lot of junior trainees, and some DGHs have a lot of junior trainees and not many seniors, for example, then the impact is going to be slightly greater. When you've got a disproportionate balance of senior trainees, you might be a little quicker, but it comes out in the wash because large training programs will have a variety of training grades. And so for us, this was a lifetime, I describe it as a safe lifetime sustainable reporting rate. And it was agreed across the whole of the APC. So, upwards of 250 radiologists. And it works. When you look at it in the cold light of day, it feels very doable. But it's supposed to be doable because this is hour after hour after hour, week after week after week, year after year after year. It's quite an undertaking. We all know that if you do a burst of activity, for example, insourcing, everybody can report a bit faster, but that's because it's their choice. So this is a rate of reporting, assuming interruptions, clinical discussions, going to the loo, having a chat with your colleague a little bit because you might want to and might need to, having a bit of a break, which is what the college recommends every now and again, and having trainees. So it's a real life scenario.
Thank you very much. There's quite a few more questions. There's a specific question around whether outsourcing costs are counted as non-pay. I'd have thought that would be fairly standard, although how you split up your accounts and whether it should be an agency spend will depend on your institution. Is that right? Yes, can you comment on that?
We categorise all of it as non-pay outsourcing, so it would never fall under pay for us. I can't imagine anyone else would follow anything different. Yeah, I would put it all to non-pay outsourcing.
Thank you. Shrivastava Manoj, sorry, you've been waiting a while to ask.
Yeah, sorry, and thanks for the lovely talks. Unfortunately, I joined a bit late, so I missed the first one. So, but just for understanding, I believe, Amrish, I was looking at your chart, and your chart did say about 1.5 is DCC for MDT, and also I got confused whether this is within your what do you call SPA time or what it is. And I'm not sure your units. I think you're basing it on 24 body parts. Is that correct?
24 points. Very different to body parts. 24 points per hour.
And that, I'm sorry, I'll have to basically visit this talk again with the first part.
Yeah, if you go on the, is it on the college website? I don't know, but
I put it in chat. Yeah, so if you scroll up in chat, I can put it back again. The spreadsheet shows number of points per exam. Per exam, yeah. Yeah,
so like I've got that up, and I based it on that only. So like 4 scans for CT neck, 4 scans per hour. That's 15 minutes per scan. So we call it body parts, you call it units. That's different. So I think 24 is the right number. All of us are talking. Now my main question is, what actually, if the workload is more, how are you balancing? Obviously, everybody must be having hot reporting sessions, and obviously there must be a session for duty radiologists as well, where they can taking talk calls and everything. How are you balancing that? Because hot reporting numbers, you cannot be fixed for a session. Is there, you have anything to calculate that, and how are you fixing that?
We do. So in the last 3 years, we've included an allocation for, last 3 years, I think it is now, included an allocation for duty or hot reporting. We've looked at the data for our hot reporters, and actually, it's actually not very different. We did think about having it as a different rate because of the number of interruptions and the number of calls, but actually the current clinical directors decided not to change the output rate. We did for a year, and then we've gone back because actually the output wasn't very different. But we recognise, of course, that particular dynamic will be different in different organisations, and it also depends on, you know, sometimes you're getting a lot of hot calls because you've got a big backlog and people are phoning through because patients are in clinic and you haven't reported it yet. So there are different reasons why you might get interrupted more, but there's no reason why you couldn't have an allocation for hot reporting and drop the rate. But of course, every time you drop the rate, it's the same as Yazmin's been saying, there's a threshold. Whichever way you do this, there's a threshold below which it starts to become a deficit problem. And then it just makes it more difficult to make the argument. It's not impossible, but it makes it more difficult to make the argument financially. And the trouble is that as things get tighter in ICBs and in trusts as a result, the financial argument starts to become bigger and bigger and bigger. So if that is a challenge for people in terms of making that financial argument, it's quite difficult to get over the line.
Thanks, Amrish. A shout out to Claire, and that Norfolk and Norwich have done a similar thing. So, you know, I wanted to showcase your work and Rob and Yazmin's work, but there are clearly other people who are achieving the same thing. So that's helpful. There's a comment about the RCR recommended outputs, and it's worth having a look at the context of that document because it is for service planning, and it is meant to be real world reporting with all the loo breaks and conversations and trainees and normal life. It is not meant to be something for managing individual people of, you know, did you do 12 of these this morning? On the next, I think we've probably got time for 1 or possibly 2 more questions. Steve Harden first.
Thank you. Just a quick comment, Robin, which is, many of you will know we're doing a bit of work at the college around the value of a consultant. And part of that is to ensure we get new consultant posts to recruit into exactly as Yazmin has described. And thank you very much, all those of you who are doing some work and sending information around us around the financing of the secondary on costs of outsourcing, so additional MDTs, additional reporting, etc. I guess my comment specifically to Amrish is a lot of the benefits you describe I presume we're in SPA time. So we talked about education supervision, talked about teaching, research, management, etc. So in many ways, that really emphasises just how important including and protecting SPA time is. That's where you really get the added benefit.
Yeah, I agree. I mean, you could think of it two ways, though, Stephen. If you have, I mean, I know there's a number of trusts in London. They're not all foundation trusts, and their standard job plan is a 9+1. And so if you think about the 9+1 equation, financially, that's going to stack up even better because there's going to be more of an output time. So financially, you're sort of making them stronger by having less of an SPA time. But actually, for us, we felt the balance was just perfect. You can make the argument financially with an 8+2, and you get all the important professional benefits of those two SPAs rather than just the one mandatory. I think departments just don't move along fast enough on the other things if all they are committed to is the one mandatory. You need, I think, for me as the CD, former CD, and as the DD, even in my non-radiology specialties now, so if you take cardiothoracic surgery, whatever, maternity, gynae, we really want to have two SPAs because that's where the added value of these professionals come in.
It's the enlightened that SPA is work too, and it's what keeps things moving in quality and improvement. Yeah, and so we have to be careful that output time isn't, and non-output time is not value time and non-value time. It's just different value time.
Correct.
Yeah. I'm going to give the last question or comment to Rob, and then we'll wrap up. But
thank you, Robin. Yeah, I wanted to follow on firstly from what Amrish has said, because without PA allocations, none of us can do the stuff that we're doing day to day. In addition, the managerial roles, the reasons that we're here now. The other thing I wanted to say is just picking back up what Yazmin commented in regard to relationships. It's really important. I couldn't have done what I've done here, Yazmin, and Yazmin couldn't have done what she has done presented today if we hadn't built a relationship that allowed us to understand mutually where we were coming from. And I think before we started this process, probably about a year ago, there was a lot of misinformation, is probably not quite the right word, but misunderstandings about what radiologists deliver within job plans. And at one point there was a commonly held belief amongst the sort of the higher levels of the trust that a radiologist job plan provided 2 PAs of reporting in this trust. And so until I understood that, I didn't know quite where I was going with trying to unpick the various issues we were facing with trying to get job plans approved, and then talking through it simply through conversations with Yaz, I was able to understand exactly how it was that they were assessing the jobs that we were trying to get advertised, and what the financial justifications that they were looking for within those posts looked like. And once I understood that, I was then able to develop the work that allows Yaz to look at each of our posts and understand the value. So it's all about making sure that in your trust you understand what your finance business partner is looking for.
So much that working together theme once again. Thank you very much, Rob. Particular thanks to David, to Amrish, and to Yaz for sharing their expertise and experiences with us.
Hello.
As I mentioned at the beginning, this is one of several webinars. The others are up on the website. The recording from this should be up there as well in time. The other elements of staying together as CDs and trying to support each other in a tough job. Make sure you're on the list, getting the emails. Let us know what you think. Similarly, the WhatsApp group. And there's a Clinical Directors Day in person. So date for your diary is Thursday the 13th of March. In London, so that we have a chance to see each other and to swap ideas. Big focus on workforce, making a happy department, looking at sustainability, international colleagues, measuring value, all sorts of good stuff, how to support trainees. It's bargain at £100, which we've done all we can to try and keep the costs down. So please come along 13th of March, and thank you very much for everyone's time tonight.